Hello and welcome to the next in our occasional series of BTRM video interviews, where we have a short but incisive, so far, conversation with a member of our faculty or representative or other interested party. It's my pleasure today to welcome Professor Dr. Michael Eichhorn, who is BTRM faculty. He is also the CRO of Credit Suisse Deutschland. So Michael, thank you very much for joining us today and welcome.
Thank you for having me.
So first of all, let's get straight into it. This is a conversation we're going to have about, surprise, surprise, last year and this year's ongoing market-wide stress event, the pandemic stress event, which has impacted banks in various ways, various levels of significance all around the world. We're going to talk about the impact of that and what we consider going forward, what we should be considering going forward. So I'm sure what you're about to say and what we're going to discuss will be of interest to not just CRO officers, but anyone involved with balance sheet risk management in banks around the world. So let's get right into it, Michael, if we may, please. So first of all, given your position and your experience over the last year and your current role, from the ALCO perspective, from the perspective of the Asset-Liability Committee, which of course the CRO is a member of in any bank, what would you say are the main lessons learned for banks from the events of 2020, from last year, and also continuing this year because the stress event is still playing out? What are the lessons learned from a balance sheet risk management point of view? Again, looking from the ALCO perspective, what would you say are those lessons learned that we should be mindful of today?
Thank you, Murad. I think I will focus on the liquidity risk lessons learned. I think on the capital side, the jury is still out, but on the liquidity side, there are a lot of lessons that have crystallized for the Asset-Liability Committee. Let me briefly recap what happened in March 2020. In my eyes, what we saw was a market-wide crisis. We saw certain funding markets were nearly closing. In capital markets, the spread spiked, leading to elevated funding costs. We saw commitment drawdown rates, in particular for non-investment grades, that rose sharply and were frequently higher than in 2008. We saw initial margin requirements that were occasionally several times higher than prior to the crisis, at times inducing systemic risk. And remarkably, they were remarkably different between clearers. I also noticed from speaking to peers and colleagues that for banks that were using the historical lookback approach for derivatives on LCR, that they saw pro-cyclicality coming through in their liquidity profile. And in addition, failed transactions often caused incremental outflows due to larger trading volumes. What I understand banks didn't see were deposit outflows or intraday liquidity usage through idiosyncratic stress elements. And in terms of what can be learned from the ALCO, I think it's fair to say that there is no one-size-fits-all, and that depending on the business model, the impacts of the effect that I laid out before may differ. However, I think there are a couple of themes that crystallized that have also crystallized in the discussions I had with peers in other banks, and I would map them to 6 areas. The first question I think I would ask any ALCO committee is how well did the protocols and processes for the crisis governance and communication work throughout the crisis. Yeah. I think there are lessons to be learned. For example, I understand sometimes there was ambiguity about when to enter the next level of the contingency funding plan and also when to leave it. I think another question I would ask is, were banks able to adjust their funding plans in time and also their concentration mix by product, by currency, by tenor, by counterparty? I think that was a prevalent question in the middle of the crisis for many banks. I think another lesson learned from banks that had to maneuver through the crisis is that how important it is to have granular forecasts, so to be able to attribute cash flows at business level and to have reliable granular short-term projections, because you don't know at business level what's around the corner. I think another topic, giving the impact that I laid out before, is collateral management. In particular, you may want to ask, did we really have a joint up front-to-back approach for margin management exposures? I think in terms of management information, what I hear and then understand is that the data was often available, it was in time, it was more a question of granularity and then being able to support decision-making at business level. And then I think with regard to the risk control framework where I'm closest as a CIO, I think the golden question is really, in the middle of the March crisis, did you manage the metric or did you manage the crisis? Did you manage the metric or did you manage the crisis? And I think with regard to the latter, if I go deeper with regard to the risk control framework, I think a couple of questions that I think should be discussed by the community and that have been crystallized throughout the crisis was the question, which entities should your risk control framework focus on? I think prior to the crisis, there was a discussion, should it be for group, material legal entities, branches, smaller entities? I think what the crisis has shown is it is about group and material legal entities. I've heard of peers that said that their local regulator came in and before he or she asked about the position of the local entity, they asked what's the position of the group, because that in and out of itself protected the entity. And in particular, I think it's relevant for branch controls. I think another question that was debated for a long time prior to the crisis was, if you're in the ALCO, should you link your risk appetite to your regulatory metric, or should you link it to your internal metric, economic metric, or both? And I think what the crisis has shown is what really matters is compliance with the regulatory metrics. I've actually heard also of cases where banks suspended their internal metric controls in order to make sure that they don't trap liquidity for regulatory compliance. What I also hear now is that there are considerations of what I would describe as an LCR plus, where you use the regulatory metric and then on top, using internal models, you add a drawable buffer that is informed by internal economic models, and that covers the risks that are not included in LCR, for example, intraday or certain prime risks.
Pillar 2 risks, Pillar 2 liquidity.
Yeah. I think another question was that prior to the crisis, concentration risk was often considered as a kind of complementary risk metric. And there was a crisis which concentration risk you should prioritize. And I think that what the crisis taught is that it's more than just a secondary consideration, and it's not possible to prioritize one concentration risk over another. I think all types of concentration risk played out. I think with regard to counterparty risk, you could see that the clearers and that you worked with really had an impact on your liquidity profile. So an ALCO committee may want to manage clearers going forward more like an investment portfolio and then optimize it. I think in terms of currency, in currency concentration, I understand that some banks found it hard in the middle of the crisis to square their nostro accounts for minor currencies. And in terms of tenor concentration, you have to imagine we were in the middle of the crisis, and I understand that banks increasingly discussed, they didn't know what's around the corner, so they did not only discuss the first 30 days, but also what's the cliff risk, for example, between day 30 and day 60 and day 90. So that became prevalent. And then in terms of product, I think the calibration of, for example, your short-term wholesale funding concentration limits almost often equated to direct outflows. I think what the crisis also taught us that, for example, with tenor concentration, how do you control this? Do you control it top down or bottom up? And I think that the crisis, prior to the crisis, I understand a lot of banks used aggregated controls. And what I mean by this is you just aggregate across the product, secured funding, unsecured funding, and so on. You aggregate and have an overall limit. What the crisis taught us, it's more intelligent to do it bottom up.
Right. Because
markets close at different points in time, and then 5 billion of concentration risk in secured is different to 5 billion in unsecured. For me, one of the even more relevant questions is how granular do you control forecast in the ALCO? You do it at group level, you do it at legal entity level or at business level. And I think in the crisis, what really matters is that you've got the ability to do it at business level. You want to steer at business level. That's what really matters in the crisis. And related but different is, how do you control the funding plan? For a start, are you able as an ALCO to revise the funding plan at short notice? But provided you are, how do you risk control it then? And there I think it's important that you've got a mechanism to track the revised funding plan, that you also are able to apply what I call stress overlays to your funding plan, that then in a subsequent step at the ALCO you can also map mitigating action to the stressed funding plan. And you can do this along a spectrum of different severities, because you are in the middle of a crisis, you don't know what's out there. And I think that's the discussion that ALCO committee should have. What I also find interesting is, and what I know has been debated, is the use of what I would describe as a dynamic buffer concept. So if new risk emerge that with the best will in the world you hadn't identified before, you assign dynamic buffers straight away at business level to make sure you reflect the incremental needs. And maybe finally, my personal lesson learned is, with regard to pre-trade approval, I think there was a long debate, should PTAs be used for liquidity risk, or are they primarily something that should be used in BAU for large and unusual transactions? And I think there was a view out there that they are less suitable to manage liquidity in a crisis. They are too bureaucratic, too slow, a lot of paperwork for nothing. And actually, I think from the discussions I also had at conference, I think it can be one of the most effective control tools. Because imagine you just lower the threshold for the PTA, and then you request the CRO to approve, or the CEO to approve any new transaction. You immediately steer the behavior of the entire bank. So in this way, I think it's one of the most effective and most underestimated tools. So in summary, I think the 5 key points that resonated with me is that I think less can be more. Focus and simplify your risk control framework. Focus it on group and material legal entity. Make sure your controls are linked to a regulatory metric plus maybe an add-on. I think another point that I understand we may touch on later is calibrate your buffers prior to the crisis so that it's clear to which extent they can actually be used in a crisis. The third point is, I think you should have, as an ALCO, you should have the courage to change risk control in the crisis. So to loosen or even suspend control and to tighten certain controls, and at the same time to tighten others, such as PTA. I also think one lesson learned was that top-down and bottom-up matters. For example, for low point, I think it makes sense to only have it at group level and overall. Otherwise, you create a lot of complexity and two-way flows between different entities. But for tenor concentration, as I said, it should be product by product, bottom-up. And then finally, switch the headlights on. Switch the headlights on. Think about your ability to revise the funding plan. Stress the revised spending plan, focus on granular forecasts, and then use tools like PTA.
Excellent. Thank you very much. There's some absolute gems in there. Thank you, Michael. We could actually spend the rest of today talking about each of those points. Before I go on to question 2, no, thank you very much. I was nodding in agreement just about every point. Just before I go on to question 2, very quickly, one thing that stood out so right at the start, you mentioned the capital still lessons to be ongoing. Agreed that. But you also mentioned about the observation there was an element of pro-cyclicality in liquidity management and liquidity buffers setting. Just elaborate there, 30 seconds, just elaborating on that. Was that a real problem, or what should we be doing to address that? I've always thought that the combination of leverage ratio and LCR had this element, and I saw some US banks suffering what I call a double whammy. You know, the LCR requirement is going up at the same time as your leverage ratio is increasing because customers are drawing down on overdraft facilities and then parking the money back with you. So, and these are large corporates. Just elaborate 30 seconds on pro-cyclicality of liquidity. I was very interested to hear that. Yeah,
it's related to the historical look-back approach that is used under the liquidity coverage ratio for derivatives. And I think the question becomes that if you're in a crisis, the method as it is at the moment would force you to upload the time series with the latest observations, which then tend to override and then basically lead to a step change in your modeled projected outflows. And the question, I think, is should you freeze the time series to avoid the shock on the shock? Or
may I just quickly say my answer would be yes, because otherwise I'm going to be extrapolating even worse than it would be. But that's just a personal view. That's a model risk issue that I'm sure we're all aware of. But no, sorry for interrupting, but I just wanted to answer that because I think yes, absolutely. Because you carry on doing that, you're going to end up with having to address something that is always looking progressively worse, especially when we're in the midst of an ongoing stress. But,
exactly.
Yeah, thank you for that. Now. I must admit, I was nodding, if not necessarily outwardly, but inwardly, vigorously at the importance of bottom-up approach. And also, right at the end, you said the adaptability, headlights on, but be responsive to events, be able to adjust risk appetites and exposures and limits upwards as well as downwards to respond to events quickly. And I think ALCO can really add value there. Thank you very much. Let's get straight on to question 2, which I know you were excited about when I suggested it to you. Now, in the UK, certainly, but also I've observed around in the Middle East and Europe, other banks, some banks at the start of the crisis stepped right back. They decided, given the uncertainty and their own balance sheet resources, they weren't going to be doing any more new business, whether with existing and let alone new customers. But other banks carried on. They were still introducing new customers, still introducing new business with new as well as existing customers, despite that we're going through a crash. I know which approach is looked upon more favorably from a customer franchise point of view. My question to you is, to what extent should this decision, whether to engage more or to draw back, be driven by balance sheet risk exposure considerations? And to what extent should it be driven by we need to support the customer franchise? I just wanted your views on this, again, from an ALCO perspective.
Thank you, Murat. I noticed that too. And to be honest, I don't think it's the right answer to step back. I think a better answer is to think of it almost like a stress continuum or crisis continuum, if you like, where you've got moderate stress, then high stress, very high stress, extreme stress, and then maybe resolution at the other end of the spectrum. And then I think it really depends on the type of the crisis. I would think in a high stress, so at one end of the spectrum, you should be able to withstand a shock without asking for regulatory forbearance, so using your buffers, and then also without hurting your franchise. I think buffers should be calibrated so that you can avoid that trade-off. Yeah. As you move to the spectrum, down the spectrum, and let's say it's a very high stress, for example, a prolonged market-wide stress, I think there you may, and that's, I think the ALCO should calibrate this before the crisis. It may be acceptable to use regulatory forbearance in agreement with a regulator for Pillar 2, but not Pillar 1. And I would still think you should not use mitigating actions that hurt your franchise. I think that you should exhaust other balance sheet measures beforehand. However, if you move further down the spectrum, and let's say there's a market-wide stress plus an idiosyncratic element, so really something extremely severe, I think there you may want to use regulatory forbearance beyond Pillar 2, or discuss it at least with the regulator. And I think then hurting the franchise as a mitigating action should also be considered, because at this point you may run out of other balance sheet measures. But I think it should be one of the last resorts. And what I also think important with regard to franchise considerations is that not only should it be done after, for example, long-term funding and other measures are exhausted, but I think ALCO should define the objective. So ALCO may say that there are certain self-funding targets for individual divisions and business units, but it should leave it to the business to determine how this can be done in the least or minimal invasive, least franchise damaging way. And I know a lot of business have a list where they already distinguish between franchise and non-franchise clients, so they will know what is the minimal invasive way. They may know better than the ALCO. ALCO should, in my eyes, focus on quantifying the targets, providing the objectives, and tracking progression against it.
But that's, in essence, supporting the business lines. That's how they support the business lines to carry on supporting the franchise, yes?
Exactly.
Yeah. Absolutely, yeah.
And I also agree with your point, and that's what people have also said to me from the business. They said it's also a golden opportunity actually to strengthen your franchise. A crisis can be a golden opportunity to strengthen your franchise. You briefly touched on the usage of buffers, and I did. I just want to also highlight that I think one aspect that needs to be considered in here when we talk about other balance sheet measures is, I think pre-COVID there was a common statement there that banks should use their HQLA buffer in a crisis, even if it temporarily means that you breach your reg requirements. After all, that's what buffers would be there for, and then not allowing for it would mean you are holding buffers on buffers. I think post-COVID, I observe that the view has changed towards that in general there is an expectation that at least for a crisis of severity of COVID, banks should remain in compliance with regulatory requirements by having sufficient drawable buffers on top of it. And I think what is important from an ALCO perspective is, and one treasurer described it for him, he said it was a price discovery. But I think what I would recommend ALCO committees is that they should be aware that different regulators have different practices.
Yes.
That regulators differ between the use, also tend to differentiate between forbearance of Pillar 1 and Pillar 2 buffers. And I would recommend that the use of forbearance should be discussed and agreed with regulators prior to any crisis. And it should differ along the spectrum or this continuum that are laid out. I also think acceptance of forbearance can be scenario dependent, and it may only be really granted if you are further down the spectrum that I laid out before. And the ALCO committee should consider that forbearance will come with conditions like revisions of the funding plan and also the expectation that you plan to restore compliance in a meaningful time frame.
Absolutely. Yeah, again, some real gems. Thank you for that. I was smiling through halfway through, talked about buffers on buffers. They are there to be used. I must admit, dipping below, we're talking about liquidity here, dipping below liquidity coverage ratio 100% is a big step. But if one had to do it to preserve the franchise and pre-advised the regulator and presented a restorative plan over this timeline, say 12, 24 months, then one's ticking all the boxes and can dip into that, and it's not a huge stigma. I do agree. I think ALCO should support the business lines. I wanted to hear that from someone who is right at the coalface at ALCO, managing the balance sheet for capital liquidity. And to hear that from you, it reinforces what I'd thought. There is a big difference between use of Pillar 2 and Pillar 1. If one needs to have forbearance for Pillar 1, that's a whole step change difference. But again, provided it's managed properly as a last resort, then one would do that. I personally think if I was chairing at ALCO at any bank, large or small, I would want to do that rather than use external support. I would rather do that than go to the central bank or the government or something like that, or look for a takeover. I'd like to preserve the franchise and the branding. And if I could present a plan for restoration, then potentially Pillar 1 is still dippable into. But absolutely agreed that. I was very happy to hear that because it accorded with my thinking. But to hear it from someone who is the CRO and attending an ALCO at a G-SIFI bank makes me think we're all on the right lines. Thank you very much for that. Now, last question. No, go ahead, sir.
Just one point. I think the important thing is you can simulate this before and you can stress this, so you can have these discussions along the spectrum risk continuum prior to the crisis to really.
Absolutely, yes. Spot on. Brilliant. Thank you. And that's all about relationship building, an open, constructive, value-added relationship with the regulator. So if we have stressed this under these scenarios, it's almost like heading towards a reverse stress test, but step one back of that. Under this scenario, we might want to do this. Here is our plan. And if you've had that conversation beforehand, you're in a much better position if you are in the crisis afterwards. Absolutely spot on. Thank you very much. Now, we have just about reached time, but I'm not going to knock it on the head just yet because I would need your pearls of wisdom on this last question. I saw a presentation from you that I think you gave at a conference recently to risk managers around the world about their ability to predict stress events or risk events, which I always find prediction, even of the cable rate, a bit of a mug's game. But let's have a look at market-wide stress events, predicting emerging risk events. I think from an ALCO perspective, the more pertinent question would be how best can we be prepared for risk events that by their nature are unpredictable? Now, you've actually touched upon some of this already during the previous conversation. I thought it would be a nice way to summarize your thoughts by addressing this specifically. How best can ALCO prepare for market-wide events which by their nature are unpredictable? We don't know what the next one looks like. So how best should we prepare? How would you summarize that, tying in together everything that you've spoken about so far on this chat?
Yeah, I agree that we cannot predict emerging risk events. It was a question at this conference in Singapore. Our track record is awful. I did the back testing. I went back and said, what did experts predict and what happened? And then also one quote that resonated with me was from Nassim Taleb. He said, nothing predictable can be truly harmful. Nothing predictable can be truly harmful, and nothing truly harmful can be predicted. And John Danielson from London School of Economics, he said one common mistake that we make is that we focus on the known unknown risk. So he said the risk we prepare for, the risks we know we prepare for, what he calls the known unknowns. The risk that we don't know is a dangerous type. These unknown unknowns are the most damaging. And I think we can prepare for the unknown unknowns, and I think the ALCO should play a key part. For me, it entails a stronger focus also on non-financial risk. I found one quote from Stuart Lewis, the CRO of Deutsche, who said in the middle of the crisis, we do a good job of understanding financial risk. You saw that in 2008 and afterwards. I think our biggest failing was on the non-financial side. So I think that should be part of it. And then I think in particular for the ALCO, it's about strategic risk. It's also about the strategic asset liability management concept that you advocate, Murat. And then there one quote from a Harvard article resonated with me, where they also said something along the lines, corporate treasurers and chief financial officers have become adept at quantifying and managing a variety of risk, financial, for example, currency fluctuations. And then it continues later, but most managers have not addressed in a systematic way the greatest threat of all, strategic risk. The array of external events and trends that can devastate a company's growth trajectory and then shareholder value. So I think thinking about strategic risk, and I still find it remarkable that there are no more strategic risk departments out there in banks, that strategy risk is still kind of thought implicitly alongside other risk. I think what the ALCO should do is focus on what I would describe as focus on resilience, and by that I mean the ability to survive whatever the future brings in different hypothetical future worlds. I think the ALCO should build a strategic vision that balances commitment and flexibility, that has all kind of real life options. I think in this, the strategic ALM, as you published on it, plays a key role. I think it is really not only the decision what do we load on our balance sheet and what don't we load on our balance sheet, but it's also to step in prior to origination, and not to try to apply treasury tools and ALCO tools at once. Everything is aggregated up and steered.
Yes, proactive rather than reactive. Absolutely spot on. A man after my own heart. Yes. Was there anything else, Michael?
Yeah, just there's one book. It's called Profiting from Uncertainty from Schumacher that I found quite interesting when I prepared for this conference. And then he is arguing that we should embrace uncertainty. We should experience multiple futures. We should build a strategic vision that survives in all these hypothetical futures. And he's literally, he would put the ALCO in a flight simulator, and he would ask them to experience scenarios that are far from routine. And it's not to predict or to pinpoint one future, but to prepare the ALCO for multiple futures, and to change the mindset and to allow for faster learning, and then to overcome this frame blindness, as I would call it. And I think, maybe as a closing thought, I know we are short of, I think it's also about using tools like scenario planning more often, but also about new tools like reverse stress testing, and also linking reverse testing in a better way to other concepts such as recovery and resolution planning. I think we've got a lot of fragmented tools at the moment, which we should map and then co-integrate and then align.
Absolutely, 100%. And I did like the flight simulator idea. I think if at the exec level, individuals could draw back from their day job, which occupies so much time, and then undertake this sort of flight simulation activity, I think ALCO would be very well placed to manage risks, unpredictable risks as they emerge. That's excellent. Thank you very much. I did run over time, but I was enjoying the chat so much. That's why. Thank you very much, Michael. Really appreciate it. Michael Eichhorn, who is, of course, CRO at Credit Suisse Deutschland, but more to the point, is also on the faculty of the certificate BTRM. A real pleasure. Thank you, my friend. And that's this evening's conversation. We'll see you again. My thanks on behalf of BTRM to Michael. And we'll see you again at the next chat. All the best and stay safe.
Thank you for having me, Murat. Pleasure.
Our pleasure. Take care, guys.
Take care.